I run back with another video today, looking at a comparison and which one I think is a better buy of JD.com and Alibaba, two massive Chinese e-commerce companies, well known to US investors in US markets, both US listed. JD the more pure play Chinese e-commerce, and Alibaba is a bit more diversified, as a nice cloud computing segment growing at 30% year over year. So I'd like to take this opportunity to remind you to subscribe if you're enjoying the content, help the channel grow. So jumping into the stock charts and seeing where they're sitting at the minute, JD.com right in the middle of its 52-week range, roughly around $88 as we speak. Down from its all-time highs of around 108. It's been a really nice company to own over the last 5 years, roughly doubling. There's been a lot of nice buying opportunities to get it lower. I know people who have 200 or 300% returns. Great company to own over the long term. Same with Alibaba. It's been a really strong company to own, depending on when you bought and sold. Right now, it's the lowest it's ever been since 2017. Right at yearly lows. It's getting really kicked around by investors at the minute for a variety of reasons, so as we'll go into later. So looking at some basic valuation metrics, JD.com trades at quite a premium, pretty much double the PE, trading at around 35 times trailing earnings, whereas Alibaba trades around 18. And again, on a forward PE basis, higher 40 compared to 14 or 15. Looking at a lot of these, you can see that price to sales ratio, they have roughly the same sales numbers, of yearly sales numbers. JD.com trades at price to sales around 1, and Alibaba trades around price to sales around 2.9. I'll explain this later, what the reason for this, or why I believe the reason for this is. But clearly, Alibaba trades at a significant price to sales premium, and JD.com trades at a significant PE ratio premium. Both at historic lows, pretty much. So as you can see from the right hand side, all of them, every margin, every index you can think of, they're trading really low versus the historical value. So both clearly depressed. JD.com stock has not done that much recently. So not that it's down like Alibaba is, but it's not done that much. And the business has done quite a lot. So the multiples have been contracted a bit. And Alibaba, the multiples have came down so much because it's growing and because the stock's getting beaten up. So taking a look at the balance sheets and the financial strength, very little to split them, roughly even in my opinion. Cash to debt, JD has a higher cash to debt ratio than Alibaba. Equity to assets, Alibaba slightly stronger. Debt to EBITDA, Alibaba slightly stronger. And debt to equity, basically the same. Not much to say here, really. Again, cash to debt, both trading at lows historically, but good versus the industry. Historically, it's probably because of supply chain issues in 2020 and 2021. You know, the margins have been a bit contracted. They're having less cash on the balance sheet because they've had to outlay to improve supply chain and logistics. This is to be expected. These are companies that should be investing a lot because they're growing at 30% year over year, and this is exactly what I expect these two companies to be doing. Overall, I would slightly give the edge to JD. It's the better cash to debt. It's significantly better. So I guess it's a bit of a safer balance sheet, more fortress-like. So looking at the profitability, these numbers on the left I don't think are completely accurate because I've got a figure from JD's Q3 report, but we'll go into that in a minute. But the point is that Alibaba's are dramatically better in every sense. Net margins are around 15%, operating margins around 10%. JD's operating margins much closer to that of a traditional retail industry. These are the type of margins, well, you'll see Overleaf, is that these are the type of margins you'll see from like a Walmart. Net margin and operating margins really not that strong. Return on equity percentage basically the same for both companies. Not much I can hurt them for here. One thing that is worth mentioning is that JD's numbers versus the previous numbers are actually very good, and they're improving these margins, albeit from a much lower base. And Alibaba's are quite depressed, basically because they've had to invest a lot in supply chain and they're continually investing. This is to be expected. I don't think this is ridiculous that they've had to spend a lot, and we all know that 2020 and 2021 have been doing that to companies. I think what's interesting in this is this should absolutely reflect in the multiples. Alibaba should be much higher valued in my opinion, which is not something we see. JD's trading roughly double the PE, and based off this alone, at similar scales, Alibaba should be trading at a significantly higher PE based on similar growth numbers, because Alibaba is just far easier to generate earnings compared to JD. So just as I mentioned, taking a bit of a deeper dive into JD's margin picture, in my opinion, consistently weak operating margins. They're steadily improving, but as you can see, big dips because when you have operating margins that are this low, even from a large revenue base, there are times when your margins can get heavily depressed. These margins are actually not that bad for commerce in general, retail and logistics, but it shows the weakness of these investments, in my opinion. And this is the reason why I think that JD is trading at a significant earnings premium over companies like Walmart and Target. They trade at similar price to sales numbers. Walmart is very low price sales. But in my opinion, JD just doesn't have the margin profile to be a 30p business, even if it is growing 30% year over year. As long as it stays a relatively pure play e-commerce company, I think this is probably slightly overvalued at 30 times. If growth slows down at all, I think this could the stock could get hit significantly. That being said, they've maintained a 30% compound annual growth rate for many years. I can't deny that. That's fantastic. And as the yearly numbers are great, they compare nicely with Amazon's compound annual growth rate. But again, the margins are more akin to Walmart, so that is a more apt comparison. Obviously, they're growing at a much faster rate. Both these numbers are in USD. There's a couple of slides have been in Chinese yuan, but both of these are in USD. But again, Alibaba is more diversified, so they have new retail initiatives. Sun Art is included in that. They have all sorts of things included, and the cloud computing segment. These are the yearly numbers on this slide. There's still quite a bit to go to Amazon, but it's grown at 30% year over year on a very large economy with low penetration. So I think this is really nice to see. As I mentioned, the Alibaba this is the most recent quarter. Showed this in a previous video. So for Chinese yuan, divide roughly by 6. It's roughly 6-to-1 ratio with the dollar at the minute. So 200 billion in sales for the quarter is roughly 30 billion USD. Really impressive. Yearly sales numbers are very similar to JD, but Alibaba has far superior margins, as I mentioned. And interestingly, they have cloud computing and digital media segments. A couple of different mixture of Chinese commerce companies. They have Taobao, Tmall, and things like that. The Alibaba platform. So there's a difference in trading from commercial resale and commercial wholesale. But the cloud computing segment is something that I'm really interested in. It's around 10% of the quarterly sales at the minute. That's about $3 billion per quarter. Fantastic, growing at 30% year over year. This could be a really, really significant segment of the business in the future. I'm very excited to see what it turns out like. So this is just a bit of a for your information slide. I'm sure a lot of regular investors don't need to know this, but the tailwinds for e-commerce in China are absolutely fantastic. So this slide's in Chinese yuan, so again, 6-to-1 with US dollars, so just divide by 6. This is from the JD Investor slide, so take that with a pinch of salt. But the future for online retail and e-commerce growth in China look absolutely fantastic. They're only at 25% e-commerce penetration. That's up 4 times since 2012. Absolutely fantastic. This sector's really exploding. There's an absolutely huge TAM, 1.4 billion people in China or something like that. Huge TAM, plenty of space for JD and Alibaba to grow together. This is not going to be a zero-sum game. I don't think this is going to be a winner-takes-all market. Alibaba and JD operate in slightly different sectors sometimes, but there's definitely a lot of overlap. But there's plenty of space for these two companies to eat on market share, as you can see from the second section. The top 20 retailers' market concentration is only 17% in China compared to 52% in the US. If those numbers could even slightly match up, then this could be an absolute explosion for these two companies in terms of revenue growth. So in summary, I think both are absolutely investment-grade opportunities, both investable in my opinion. The market has absolutely smashed Alibaba for mostly external factors, in my opinion. The Jack Ma disappearing, the Ant Group IPO, they seem to have been hit much harder by the type of US, China and delistment worries. I don't think these are affecting JD anywhere near as much, because I think JD is probably slightly below fair value at the minute, right around there. Whereas Alibaba, as you can see, as from a previous video doing a DCF, Alibaba is significantly undervalued, and its yearly highs are probably about where its valuation is. I can't remember off the top of my head, but maybe even a bit below that. So you're looking at 50% upside minimum. JD has a valuation premium that it doesn't really deserve. I mean, Alibaba has far superior margins, more growth levers to pull, particularly in cloud computing, which is only going to increase the margin profile better, in my opinion. I just don't think pure play retail is a very attractive industry for share price growth. Margin game is very hard. I mean, see Walmart. Walmart has not been a fantastic stock to own over the last 5 to 10 years, partly because the margin picture is so rough. They have to increase revenue an enormous amount to pump the PE multiples up. For me, JD.com is online Walmart, looking at the fundamentals, and Alibaba has Amazon-like potential in terms of its optionality. Both are very strong, and I think both have bright futures. But for me, Alibaba is cheaper by most metrics. They're both growing at roughly 30% per year, pretty much the same, similar balance sheets. It's just Alibaba's financial profile and future prospects are far better, in my opinion. And this is why I recently started a position in Alibaba. I was considering both companies. I'm still considering JD and continue to watch it, but I think Alibaba's margin profile just tips it over the edge. And I really like that optionality with cloud computing. So thank you for watching. Bye.